Welcome. I'm Liliana Rojas Suarez, Director of the Latin American Initiative at the Center for Global Development, and I'm delighted to moderate this discussion jointly organized with the Florence School of Banking and Finance of the European University Institute. We have today four highly distinguished panelists. Joyce Chan, Chair of the Global Research of JP Morgan, Víctor Gaspar, Director of the Fiscal Affairs Department at the International Monetary Fund, Leonardo Villar, Governor, Central Bank of Colombia, and Boris Ojcik, Governor of the Central Bank of Croatia. To join in my welcoming and thanks to all of you, let me introduce Thorsten Beck, the Director of the Florence School of Banking and Finance. Thorsten, please.
Thank you very much, Liliana, and also my hearty welcome here from Florence, from the European University Institute. We are delighted to co-host this event with the Center for Global Development. And when we started discussing this topic, sovereign debt, financial stability, that was last year. We were just coming out of the pandemic, or we were not just coming out. We were kind of seeing the light at the end of the tunnel. Back then, the main concerns were over-indebtedness from the pandemic on the sovereign level, on the corporate level, the implications for corporate fragility, for bank fragility, what would it do possibly for sovereign fragility. At the same time, as it had become clear that monetary policy would be normalized, if not even tightened. Now, since our first conversations late last year, of course, lots of other things have happened. We had the invasion of Ukraine by Russia, with all of the negative consequences, beyond, of course, the misery in Ukraine, the increase in the commodity prices, increase inflation, the fear of a global recession, and of course a run towards even more tightening, more rapid tightening in some of the core countries, especially in the US, over the last couple of weeks and months. Now we call this we want to have a dialogue between Europe, Latin America, views on the two regions. And of course, when we do that, you could argue on the one hand, there is lots of evidence for global financial cycles, and I think we're going to see this again this time around. On the other hand, and to paraphrase I forgot who it was, the Russian author, every country is fragile in their own way. So there, I think, also a lot to be learned from the different perspectives of Europe and Latin America, and that's exactly the purpose why Liliana and I and our colleagues have come together and put together this panel to see the two perspectives and what we can learn from each other. So I'm very much looking forward. I'm very grateful to all the panelists, of course, to Liliana for moderating this, and I look very much forward to very exciting and important discussions. Thank you, Liliana.
Thank you so much, Thorsten. Yeah, indeed, it's a pleasure having you all here. And as you have just said very clearly, it seems to be that the world is experiencing shock after shock, and that the Ukrainian war has drastically complicated the economic and financial landscape, since it's having severe impacts on global trade, have accentuated the supply chain disruptions that we already had before the war, and has drastically increased inflationary pressures that had also started before the war. And so, as you also mentioned, there is a fear of a global recession. Right now, the projections for growth in both Europe and Latin America are on the downward side, right? Every time we hear a new projection, it's even lower than the previous one. For Latin America, now we're expecting only a meager 2% for 2022. And there is a lot of discussion in Europe, and the consensus right now is about between 2.5 or 2.9% for the Eurozone. So let's dig into our conversation, and let's start with a first diagnosis of a global risk. So perhaps I could start with Víctor and ask you, what are your views about what is the most important, or what are the most important global risks affecting debt sustainability and financial stability issues around the globe?
Thanks so much, Liliana. Such a pleasure to be here with you, Thorsten, and my partners in the panel. I would like to start the story with the response to the pandemic and what we at the International Monetary Fund called a great financing divide. So the ability of countries to respond to the pandemic was different in accordance with their financial capacity, their access to capital markets, and advanced economies have engaged in a fiscal response backed by very strong complementarities between monetary and fiscal policy in a context where inflation was too low and monetary policy needed support, while in general, emerging markets faced much tighter financing constraints and had to face much stricter limits to what they could do. To give an order of magnitude, if we look at 15 Latin American countries, the increase in discretionary spending was of the order of $240 billion, definitely a very large amount. But if one focuses on the four largest European countries alone, the comparable amount is almost $1,600 billion. And in a sense, this type of contrast is also clear in terms of medium-term growth perspectives, with advanced economies projected to go back to pre-COVID-19 growth paths by 2024, while emerging market economies are projected to be below trend by 5 percentage points on the same period. Now, you already referred, Liliana, that we have been facing a crisis upon crisis, and risks remain elevated in many fronts. I would probably start with price stability. Price stability is not, we know, a sufficient condition for financial stability, the theme of our session, but it's definitely necessary. And that's why it's so important that central banks act decisively to keep inflation dynamics, and inflation expectations under control. Secondly, and you also, and Torsten referred to that, global debt is very high, public debt, non-financial corporate debt, and that is something that, as Torsten emphasized in his introduction, has been associated with elements of financial fragility. So financial stability is definitely something that authorities have to be very concerned with. Moreover, and more recently, the war in Ukraine has characteristics of a supply shock, pushing inflation further up and economic prospects down, and has been associated with geopolitical fragmentation. I cannot stop before mentioning in passing the importance of the climate change challenge, and the urgency of tackling climate change with the horizon of 2030 in mind. I'm sorry I had to be so telegraphic, but that's the constraint of participating in a panel. I stop here.
Thank you so much, Vitor. Yes, we'll have many rounds of discussion, so there will be more opportunity to expand. Joyce, building up on what Vitor said, what do markets say about the increasingly risky global landscape? In addition to capital flow reversals and flight to safe assets that limits the capacity to refinance outstanding debt obligations for many countries, are you concerned about the recession in the US adding to existing problems?
Yeah. Yeah. Hello. And so Liliana, that's directed at me. I'm just
Yes, Joyce,
wanted
thank
to.
you.
Okay, thank you so much, Liliana, and a pleasure to be with you and Victor, with Thorsten, and also with Leonardo and Boris. So I think it's premature to call for a recession, but we are projecting subpar, below potential growth. And I just want to walk through the changes that we have done to our forecast since the Russia-Ukraine crisis across the globe, and talk more about the emerging markets. So I do think we are in a period of regime change where we are looking at higher inflation and lower growth. We've downgraded since February first half growth to only 1.4% globally. So that's actually 2.6 percentage points lower than pre-invasion. Now, there's divergence between regions. The Euro area, we have 3.3 percentage points lower, bringing this down to only 1.7% growth for the first half of the year. And we've reduced US growth by about half of that. To by 1.7%, but U.S. growth for the first half is just hovering around 1%, and we do think that U.S. GDP growth is going to fall below potential to 1.5% by the first half of next year, and that's on the back of a combination of tighter financial conditions, a stronger dollar, lower equity prices, higher mortgage rates that are going to weigh on demand growth. So let's now take a look at what's happened in emerging markets. We have actually lowered the emerging markets growth forecast by 3.5 percentage points for the first half of the year. We've raised the inflation forecast by 2.2 percentage points, and we've added in more monetary tightening for 2022. And even though the emerging markets central banks started the tightening process earlier last summer, we still have more than half of emerging market central banks raising rates. Very importantly, we have taken down the China forecast to only 3.7%. Now, this is going to be the second year that China has actually missed its official growth forecast, which is 5.5%. The other year being 2020, the year that the pandemic broke out. And what we are seeing in China, is having an impact on the rest of emerging markets. We estimate that every 1 percentage point decline in China's growth can take down the rest of emerging markets' growth by about 0.6% when you annualize this. Now, we're not annualizing this because China has put into place a number of stimulus measures, but it's another hit on emerging markets' growth. So we have emerging markets this year growing only 3.5%, and there's wide divergence within this. Russia is going to undergo a recession that's worse than the 1998 crisis. Inflation is going to spike, but ironically, the current account is actually the largest that it's been in 2 decades. The Central European countries, which are closer to the epicenter of the war, will also see lower growth, higher inflation, more rate hikes. And then you have commodity exporters that are helped by the better terms of trade. But we are seeing, because of China's slowdown, because of not just the concerns about China's growth outlook, the geopolitical concerns, the concerns about secondary sanctions, we're seeing outflows from China for the first time on China bonds. We've actually seen 47 billion of capital outflows just since February, after China had received record inflows in 2020. And just taking a look at this and putting it in a broader market context. So taking a look at the global fixed income markets and the US fixed income markets, the 135 basis point move in US Treasury yields has actually contributed to the worst returns we've seen in US fixed income markets in 40 years. And if you take a look at the S&P 500, we are actually looking at the fourth worst start to the S&P 500 of the last century. So we've had financial conditions change, I think, much more rapidly than expected. Now, the silver lining in all of this is that this period of very low interest rates, many countries were able to borrow at longer duration and at lower cost. And so the immediate refinancing needs, appear to be manageable for most countries. But there's real divergence in this, and we are seeing, in particular, in the frontier markets, a much more stress in those markets. And when we take a look at this from a credit rating perspective, now about 50% of the emerging markets are rated single B, triple C, or D for default. And that's a huge change from what we had talked about as emerging markets as an asset class years ago, about emerging markets going to investment grade. There are actually 16 emerging markets that are trading now at spreads that are north of 1,000 basis points for their sovereign debt. So, it is a challenging period right now. What we've seen, though, is a lot of resilience in the major emerging markets countries. And we have seen that, though that there will be just, I think, some continued pressures that will remain in place, just given our outlook for global growth going forward. We have the U.S. growing 2.7% this year, but slowing down to 1.8%, next year. And when we take a look at potential growth rates, we're looking at U.S. potential growth at 1.5%, and even for China to come down eventually to a 3 handle on potential growth, in large part for both countries because of the demographics. So we're in a challenging period now, and very much as Victor has said, emerging markets had already been is below trend compared to the recovery, the closing of the output gaps we've seen in the developed markets. But we also saw, in particular for Latin America, that it was already sort of in a very low growth position coming into this pandemic. So some of those pressures are even more exacerbated. So it is a challenging period for emerging markets. We're looking at Latin America growth very much as you at 2% this year, but 1.3% next year, and so below potential, and having gone into the pandemic below potential. So these are challenges that lie ahead. Taking a look at the debt side, the public sector debt burden in the pandemic, we estimate increased about 17 percentage points globally, while the central bank balance sheets increased 21 percentage points of GDP globally. So we're going in with more elevated debt levels as well, in addition to the geopolitical risks. Monetary authorities, I think, will have to remain on the move in the context of this high inflation. And I think the financial stability concerns, are not going to go away very quickly as we see tighter global liquidity challenges and a difficult environment to do the fiscal consolidation. So let me stop there.
Thank you, Joyce. A very grim perspective from the whole world. Let's move into the perspective of those players in the ground, right? Boris, we know that Europe has been tremendously impacted by the Ukrainian war, and that these effects are even larger for countries with close proximity to the conflict, like like Croatia. How is the war affecting the economic and financial stability in Europe, and more specifically, Southeastern Europe? Is the global squeeze of liquidity adding to the current challenges of the region?
Hello, and thank you for inviting me. It's a pleasure to be with all of you here and discuss the newest developments. As for the Europe, I would say it's not, as you said, also it's not the same story for all the countries. Those in Central and East Europe are more affected with what we've seen over the last couple of months than most of the Europe. But let me put it this way: it's pretty much the same as Joyce has said. We are entering the phase of a lower growth and higher inflation in Europe, with the growth being downgraded by approximately 1 percentage point so far for the Eurozone, and a little bit more for the Central and East European countries closer to the conflict, where we see the downgrades of growth between 1.5 to 2.5 percentage points for this year. Inflation rate being growing for all countries, more for Central and East European countries, regardless of whether they are in the Eurozone or they are non-Eurozone countries. Some countries seeing now the inflation rates already of 20%, like, for example, Estonia, and basically general level of prices coming to a double-digit or close to double-digit increases. This obviously poses challenges for the policy reaction in Europe. Of course, this comes after the pandemic, where the debt levels increased. Average government debt in Europe rose to 90% on average, but with high differences between the countries, with some countries being below 60% and some having a debt levels of close to 150% of GDP or even more. Now, with the inflation rate increasing at the pace that it is now, the issue for the ECB is how fast to react. What we have seen is that the Fed has already started the exit from the ultra-loose monetary policy, while the ECB has not really done it yet, but has announced doing it, which of course affected the markets. Already much of it is priced in, but we have not seen much of the action so far. The risk is there that once the normalization starts, there will be possibly a fragmentation in the European market, in the Eurozone. But I would say that the short-term risks are not that high because of what Joyce has said. The long period of ultra-low interest rates has helped countries to borrow long-term at very low rates. So the short-term effect should not be that significant. However, I think we're exiting this period of very low interest rates for now, a prolonged period of time in the future, and the markets will also look at it like that. We might come to a point in Europe where the interest rates on debt of some countries come to the levels where the snowball effect, R minus G, becomes an issue again for the markets. As for the Central and East European countries, there you see a clear difference of being within the Eurozone versus being out of the Eurozone. This crisis once again proves that for the EU countries which are out of the Eurozone, it's less pleasant to be in the crisis. We've seen the increases in the interest rates of countries like Czech Republic, Poland, Hungary to the levels of 5-6% already, without ECB even acting on their interest rate, staying in the negative territory. So they have already had a difficult time without, of course, being able to immediately affecting the inflation rate, as the monetary policy works with the time lag. But once the ECB starts to normalize, that will put additional pressure on these countries probably to do even more, particularly because of the exchange rate issues, whereby I don't think that anybody wants to see a significant depreciation at the time of the high inflation, when most of this inflation is actually imported inflation. So that would only add to the problems in these countries. Also, Europe clearly, as opposed to most other parts of the world, is now affected with a significant negative terms of trade shock, which is there to last again from what we see at the moment. It will have obviously longer-term negative impact on the potential rate of growth of the GDP, with also, I would say, near-term significant risks on the GDP outlook if in autumn there is a stop in the gas supplies to Europe from Russia. That might bring countries like Germany or Italy to a recession, further aggravate the growth outlook for Europe. Of course, these things are geopolitical questions which are difficult to answer for the economies, but this is clearly a risk in the near term. And maybe I stop here for now.
Thank you very much, Boris. move now to Leonardo to discuss about Latin America. At the onset of the Ukrainian war, Latin America didn't seem to be very much affected. Indeed, many countries even had currencies appreciation based on the positive terms of trade shock, as I've said, in a number of countries. In contrast to Europe, do you think, Leonardo, that is the global squeeze in liquidity a more severe challenge for growth prospects and financial stability in Latin America than the economic effects of the Ukrainian war?
Okay, thank you, Liliana. I would like to start by thanking you and Thorsten for this very nice invitation, and by saying that I feel very honored of being sharing the panel with Boris and Chan and Joyce Chan and Vitor Gaspar. Um, well, we have gone through very complex set of shocks during the last 2 years. We first had this pandemic, which implied very large fiscal deficits in all of our countries, and which left us with a much higher public debts. Now we have this increase in interest rates and tightening of global markets that will make everything more difficult now. And in addition to that, we have the war in the Ukrainian war. And I will start by saying that it is very difficult to say that anything good can come out from the war. But in the very short run, from the economic perspective of Latin American countries, there may be three types of positive impacts of what is happening in Ukraine. The first thing is that the prices of our exported commodities went up very sharply. In the case of Colombia, we are oil and coal and nickel exporters, so that, of course, implied that our terms of trade had a very positive shock since the start of the war. Second, there was some rebalancing of portfolios because some capital that was portfolio capital that was invested in Russia and in the countries in the area, and of course in Ukraine, left the area and went to Latin America, which is far from the conflict in geographical terms, and at the same time is benefiting from this surge in the terms of trade. And these two things implied that our currencies appreciated in a significant way since the end of February, when the war started, and until more or less mid-April. Now, looking farther than the very short run, we can see at least three much more persistent and damaging effects of the war. The first, of course, is the fact that the impact of the war on food prices and on the prices of our agricultural inputs added to the inflationary pressures that we were already facing. This will delay the convergence of food inflation towards normal levels and is affecting inflation expectations. And that will make the job of central banks much more difficult. In our case, in Colombia, food prices represent more or less 30% of the CPI basket, and food prices are rising by more than 26%. This explains to a large extent the fact that we have global inflation, headline inflation, at 9.2% yearly in last April. Now, this is happening worldwide, the increase in inflation, the shock of the Ukrainian war on inflation through food prices and through energy prices. This is also requiring higher interest rates from the advanced economies, and that implies also higher risk premia for emerging markets. And this may lead to capital outflows from emerging economies. In the beginning, we didn't feel that, but starting in mid-April, we started to feel that very strongly when it became clear that the U.S. would increase the pace of adjusting the interest rate and of tightening the monetary policy. The appreciation of the dollar was huge, and the depreciation of all of our currencies were very important as well. We had in the beginning, as I already mentioned, some capital inflows to the region, to Latin America, but starting in mid-April, that has reversed, and we had a period of capital outflows, which has been less severe in the last week or 2 weeks, but was very strong in the previous period. So the challenges for the future are very important now. We have today high inflation, GDP growth decelerating in most parts of the world. In the Colombian case, growth for 2023 is still very positive. We grew by 10.7% last year, and we are expected to grow by 5% this year, which is a very positive number, and which is in that sense somewhat different from the rest of the region in Latin America. But I will stop here for now.
Okay, thank you, Leonardo. Let's start focusing now on our conversation on the central issue of this panel, which is sovereign debt sustainability and management in both Latin America and Europe. Let me ask the panelists so that we can have many more rounds, or at least a couple of more rounds, to have very short answers. Please don't go beyond 2 minutes and a half for your answer. That would help a lot, the flow. So let's start with Europe for first Victor and then Boris. Victor, the IMF monitors fiscal indicators around the world. So given the turbulent global landscape, what are your views about the potential emergence of severe sovereign debt problems in Europe? Do you think that the region is much better positioned now, building up from the lessons learned from the drastic debt problems of 2010-11? Has there been improvements in sovereign debt management?
Thanks, Liliana. Allow me, in the 2 minutes that you allotted to me, to contrast and draw parallels between Latin America and Europe. I found 2 wonderful quotes. One from Europe, Jean Monnet. He famously said, "Europe will be forged in crisis and will be the sum of the solutions adopted for those crises." And for Latin America, Eduardo Galeano said, "Development is a voyage with more shipwrecks than navigators." It turns out that, in my view, the 2 quotes apply equally well to both regions. Latin America has witnessed quite important progress in institutional building in the last decades. Just think about fiscal rules in many countries. Just think about the adoption inflation targeting, central bank independence in some others. And as you said, Liliana, it's very clear that in the last decade or so, there has been quite a spectacular institutional building in Europe, with many red lines that were present before the sovereign debt crisis in the euro area being basically deleted, and tremendous progress in many areas having to do with the possibility of financing of last resort, the ability of Europe acting together to respond to the crisis, institutions in the area of financial stability, including the single supervisory mechanism and much else. But clearly, the work is not yet fully done. There are further steps to be taken in the area of capital market integration, in the area of financial integration. There's still some steps to be taken in the area of banking union, and some technical details having to do with the functioning of the crisis management mechanisms themselves. So a lot of progress, Liliana. Yes. Job completely done? No, it's still work in progress.
Thank you, Victor. Perfect. Thank you so much. I truly appreciate that. Okay. So Boris, based on the context that Victor has clearly put in front of us, has, in your view, private and government debt sustainability become an issue in Eastern Europe and Croatia in the wake of COVID-19 and government support programs? Will this become an issue in the light of inflation, the Ukraine conflict, and normalization of interest rates both by the US and the ECB?
First of all, I agree with Victor on he was talking about the Eurozone, really, about the architecture of the Eurozone. On the non-Euro Central East European countries, the situation in terms of the debt to GDP is better, because these countries typically have a low debt to GDP ratios compared to the one in the Eurozone. Although even the Eurozone is not high. If you look at the average debt to GDP in the Eurozone, it's if it would be a fiscal union and the second largest currency zone, it would be very manageable. The problem is not the average level. The problem is the differences in the debt levels between the different countries. Well, for that, of course, the Eurozone has to complete the architecture. It has done quite a lot since the great financial crisis, as Victor has said, but not all. There are countries which have been basically bailed out in a very nice way, like Greece by the ESM, which proved to be functioning very well with its programs. But we also know we have bigger countries which cannot be met by the capacity of the ESM. As for the Central and East Europe, the non-Eurozone countries, I wouldn't say that we see any immediate threats of the sovereign debt problem, because the level of the public debt, as I said, is lower. But we do see post-COVID increase in the debt levels. Now, some countries have, like mine own, have shown in 2021 immediately in the first year that you can reduce the public debt to GDP level by a lot. In Croatia, it decreased by 8 percentage points, 7.9 in 1 year, because of the high rate of growth and because the fiscal deficit was kept below 3% and the growth was 10.2%. This is basically a way to go. We know that we have in good times to open up the fiscal space so that we can have fiscal space in the bad time. Now, for that, you need two things. You need a prudent fiscal policy and you need some growth. Without the growth, it's difficult to do it. What do you need for growth? Structural policies. Now, then we get into the difficult territory. We all know that structural policy should be done. They are rarely done. There are political economy obstacles to doing them. But in the end, it all depends on the politicians, how aware they are of the risks and that they have to do structural to prop up the growth. again, if you look at the fiscal part, you do need a prudent fiscal. There are a lot of challenges now in Europe, and that pertains both to Central and East Europe, non-Eurozone countries, and the Eurozone countries. You have environmental policies, which, if anything, will increase fiscal costs. You have negative terms of trade shock, energy, where governments are faced with political calls to alleviate the impact of the high energy prices on the population. And they have deployed already fiscal resources to do that, might be tempted to do more in the future. And the third, Europe has decided to increase the defense spending. I mean, if you look at the Europe overall, it's in the past has benefited from the cheap energy from Russia, cheap gas from Russia, and let's say cheap defense from the US. Now that has changed. So it's a kind of a double negative in terms of trade shock, which definitely, in my view, poses a medium-term fiscal risks for all European countries. That calls into a question even more a necessity to do structural reform and to do more on the growth, because it will be difficult not to do environment, not to do defense in this situation, and energy is there at least for some time to stay as a higher cost. Demography also doesn't play a positive role there. That will lead to the pressures, probably also on the inflation, which also has a negative feedback loop into the fiscal issues. And hope, of course, is with technology. Technology usually saves the day in the end, but it takes time. We're not yet there. So in the meantime, we have to do some other things, I think.
Thank you, Boris. If you think that structural reforms are hard in Europe, well, Latin America has really been quite challenging in that regard. So let's move a little bit to Latin America. Joyce, do you see the emergence of widespread sovereign debt crisis in Latin America? You know, are you at all concerned about the comeback of an era such as the debt crisis in the 80s, or is the region much better prepared now and we should be worried only about a handful of countries?
So, I think it really is worry in more of a handful of countries. I mean, for the major countries, they've had market access and they have built up buffers. But we've done an exercise where we've taken a look at 52 countries across emerging markets, and we really tried to take into account their repayment risk in 2022 and 2023, so the immediate repayment risk. And we looked at 3 dimensions. We looked at the external financing risk, the fiscal financing risk, and the debt sustainability to come to a risk score. And the only countries in Latin America that we really see as being vulnerable at this stage to something like reserve depletion by the end of 2023, it's Bahamas, Belize, Grenada. It's some of these smaller countries. But all of that said, we are seeing a slowdown in market access for the country. Some of this is by choice, but sovereign borrowing last year for emerging markets was 137 billion. It's been about 45 billion year to date. Half of that drop was actually in the Central European and Middle Eastern countries and the EMEA countries. And then we've seen the corporate issuance, which had really been hitting record levels, 537 billion last year, come down to 125 billion in corporate issuance. So, but the fact that these buffers were built out means that we've had just really the frontier markets being more vulnerable. There's a couple of other indicators that we also look to for sustainability, and one of them is the cost of debt and the interest to revenues. And on this front, we actually see a sample of countries where there's been a 3-fold increase over the last decade in just the interest payments they need to make compared to the revenues. The only one in Latin America that really falls into that category is Costa Rica. But it is a tougher period for the frontier markets. And I would sort of differentiate that. I would just say, on the overall Latin debt numbers, I mean, if we look at the overall region for general government debt, at 62% of GDP. There are other regions that are higher, but there's a lot of variation within this. You have on the high side, Brazil, 81%, Costa Rica, 88%. But then you also have, going to Mexico, like half that level. 41% of GDP looking at the countries. But we're really seeing also a change in the financing. And as I said, some of the market access has come down. It's more bilateral funding, less multilateral funding, and less market debt that we see going forward as far as the key trends.
Thank you, Joyce. Leonardo, Joyce doesn't have Colombia in the list, so that's a very good news. However, Colombia's sovereign debt ratio have been increasing over the last years alongside large fiscal deficits, although we have to recognize that the ratio of short-term external debt to international reserves has remained quite stable. Do you have any concerns on that grounds about the possibility of perhaps not immediate, but building up problems on the debt sustainability in Colombia?
Well, indeed, Colombia's risk perception has increased more rapidly than in other countries, other major countries in the region in Latin America, especially during last year. During last year, the CDS indicator rose much more for Colombia than for Chile, Peru, or Mexico. And now we are more similar to Brazil than we were before, and our spreads are much higher than for Mexico, say. Now that I think has a lot to do with what happened with the fiscal deficit. The fiscal deficit in Colombia was, as everywhere, huge in 2020, but in 2021 it was reduced very significantly in most countries and not as fast in the case of Colombia. But the good part of the story is that at the end, with the figures that we knew this year about what had happened with the fiscal numbers in 2021, the improvement in the fiscal situation was much better. The debt over GDP ratio started to decline already in 2021 and is expected to decline further in 2022. Still, it is very clear that we have huge challenges, but I would also say that the outlook of rapid growth for Colombia is very positive in this perspective. We have been, I already mentioned, we grew very fast in 2021, but we are expected to grow much faster than the rest of the countries in the region in 2022. Of course, less rapidly than in 2021, but still with a rate of growth of about 5% in 2022, which will help to keep this downward trend in debt over GDP ratios. We also have a fiscal rule in place. We are, of course, have a lot of uncertainty today because we are in the middle of the elections. We have the second round of election in just a little bit more than 2 weeks. And uncertainty is important, and that's something that has affected most of the countries in the region, especially Chile and Peru in the recent period, and perhaps in the next future, Brazil as well. But my own feeling is that the institutions of Colombia will prove to be very resilient, will show that we can continue growing. We have, of course, a huge challenge with inflation, which has gone up as in all the other countries in the world, but we are adjusting monetary policy, and we expect a much better situation in the second half of the year.
Thank you, Leonardo. Let's dig a little bit into this relationship that actually was very present during the global financial crisis in a number of countries, which is the relationship between the sovereign debt and the bank fragilities nexus. In several countries at this time, government bonds represent a substantial amount of their bank's assets. At the same time, in some countries, Colombia, Mexico, Peru, foreign investors hold a significant proportion of total local currency sovereign bonds. As increases in interest rates in the United States are conducive to a decline in appetite for emerging markets and other risky assets, there could be a sharp and sustained sell-off of sovereign bonds. The resulting decrease in the value of assets would then deteriorate banks' balance sheets in several countries. So, again, please keeping your answers quite short. Please, Leonardo, Colombia is an example of a country where foreigners hold a significant proportion of total local currency bonds. Do you think, or in your view, would an important move of foreigners out of these assets compromise banking stability in Colombia?
No, not at all. Of course, we have a challenge, and this is very important to keep foreign investors in Colombia from the point of view of the financing of the government and of the fiscal deficit, which is still significant. But from the point of view of the financial system, what we see is a banking sector which is very, very solid, which is surprisingly solid after the recession we had 2 years ago, and which is not much dependent on this type of assets. What we have is some non-banking institutions, especially the pension funds, that have had some losses and some decline in the value of their assets because of the increase in spreads and the increase in interest rates. But that is not likely to create any type of systemic risk. So from that point of view, I see the banking sector very solid. The credit growth is very rapid today. It is even so rapid that we have had to increase interest rates, partly because of that, because we start to be worried about the increase in debt, in indebtedness of the households. But that is a very different type of risk compared to this idea of a crisis coming out from the sovereign crisis.
Thank you, Leonardo. Joyce, what in your view are the chances of a large sell-off of government bonds from emerging markets by international investors? Are you concerned about the sovereign-backed nexus problem?
Well, we have seen outflows from emerging markets bonds, which is rare. So year to date, we've had outflows of over 21 billion. And I think one of the interesting things is that we've had outflows from the hard currency sovereign bonds, which is unusual, about 13 billion, because the MB, that's usually sort of been the bellwether, plain vanilla. Emerging markets local currency has, for many years, just not received inflows because the EMFX is really used as a shock absorber during points of crises. We've really seen no inflows over the last 5 years. So I think the surprise this year is in hard currency. We've seen more outflows. Now, some of this is about the China story and overall risk. But I think that, at this point in time, I'm not really looking at a major correction for the key emerging markets countries. I'm more worried, though, about the frontier market countries, and I'm more worried about the future prospects for receiving capital flows, just given some of the growth and inflation risk that we've been talking about, and also some of the China risk on top of that, just given the connectivity of emerging markets to China. And I think, a lot of the question is, what are we going to do about these frontier markets? Because I would really separate that from talking about emerging markets at large, because you've got China, which is still the largest creditor, but in emerging markets, you have sort of the middle income, large emerging markets, which really through this crisis showed a lot of resilience and managed things quite responsibly given the nature of the shocks. But then you have the frontier market countries where there really is a need for restructuring and separating that and coming up with a process that makes more sense, just given the number of countries that are now falling in that umbrella. That's still a relatively small part of the EM sovereign bond index, I have to say. It's a lot of countries, 16 countries that are over 1,000 basis points in spreads, but it's not the majority of the countries. But we are seeing more stress in how you sell emerging markets as an asset class. And a lot of that stress is just this reversal of the thought process on the Washington consensus that so many EM countries had grown up with, the story of convergence and growth and free trade and investment, where a lot of that is being challenged with some of the geopolitical rhetoric that we see coming out now.
Thank you very much, Joyce, for that perspective. Vitor, the IMF in its latest Global Financial Stability Report has identified the sovereign-backed nexus as increasingly a problem evident in emerging markets. You have experienced firsthand this challenge during the European crisis because you were Minister of Finance of Portugal during the time of the crisis. What are your recommendations for emerging market today when risk of crisis are escalating but have not yet fully materialized?
So allow me a little introduction in the way of perspective. The sovereign bank nexus was so strong during the period of sovereign debt crisis in the euro area that you referred to, that many people in the literature refer to it as the doom loop. And the doom loop can work both ways. Sovereign debt weaknesses may translate into bank balance sheet fragility, and then we have an amplification mechanism that Boris actually has already described. And you're absolutely right that the last Global Financial Stability Report does have a chapter where my colleagues from the Money and Capital Markets Department look at possible vulnerabilities in emerging markets. And one of the aspects is the importance of holdings of public debt by domestic banks. And the number that the JFSR quotes is that the importance of these assets was at a record level in 2021 with 17%. So clearly, we have here something which is worth looking at. Mm-hmm. The recommendations have to do with the reduction in risks associated with public sector debt, reduction in risks associated with private sector debt. But allow me to focus on the public sector. And I would make one point which is very clear and very intuitive, which is for public debt to be a safe asset, public finance risks have to be managed professionally and they have to be managed transparently. And from that viewpoint, public finance management practices are extremely important. But being on a panel with Leonardo and Boris, I want to make what I call the treasurer's case for price stability. Most bonds in the real world, contrary to bonds in economic models, are not indexed to the price level. So they promise nominal cash flows. And so strong demand for government bonds requires price stability. It requires low and stable inflation. It requires that investors believe that inflation is going to be low and stable. If not, the demand for sovereign bonds will erode, and with it, financial fragility will increase. And that is one theme that we explored in the latest issue of the Fiscal Monitor, Liliana.
Peter, that's a very, very important and interesting point, and your view now is a little more conservative, and putting the risk. That's what we have heard so far. Let's see what we hear from Boris. Boris, over the past 2 decades, Croatia has developed from an emerging European economy to an EU member, and now is as close as next January to become a member of the euro area. Congratulations. And thus be part of one of the major reserve currencies in the world, I know. Given your experience over the past 2 decades, what would be your recommendation for emerging markets, for central bankers, from emerging markets today, in light of increasing debt burdens, increasing interest rates, and possibly spillover effects from between banks and the sovereign?
Well, I would agree, obviously, with what Peter has said. The key thing is really management of the public sector debt risk, and of course also the private sector risk. As for the private sector risk, I would say we have more reliable price mechanism, in a sense that the private sector risk is risk weighted in our prudential requirements for capital of the banks, while the public sector risk is weighted with zero. Well, whether it's zero or not is a very difficult question. I would always say it's not zero. We've seen it's not zero, but it is zero. And when something is zero, then you buy a lot of that. You're attracted to buy a lot of that, and then you really depend on how this risk is managed by the one that issues a risk. In ideal world, you would have some risk weight for the government debt. In ideal world, as a regulator, because I'm also prudential regulator and I'm a supervisor, I would also limit the exposure of banks to the sovereign debt. That would be the best way to manage this risk, as we have the same thing with the private sector. Now, that of course becomes a political issue, and as long as this is a political issue, we have to really rely on how this risk, which is on the balance sheet of the banks, is managed from the side of the governments who issued that. If we talk about the other side of the loop, I think that now we are in a significantly better position than we were during the great financial crisis, and that it's much less likely that we would see something like the Irish case or Dutch Belgium even banks which went down because of the huge exposure to the liquidity risk. We might have some bubbles in the asset markets. We might have some significant exposure of the banks towards that, but banks are much better capitalized and banks have much better liquidity ratios. So I think this risk is at the moment much smaller than it used to have been before. And I would say that the sovereign risk is also now lower than it used to be at that time, among other things because of what was said before, that we have mechanisms in Europe to deal with that, and that as we speak, we talk about the development of additional instruments in the case of a need to deal with these issues. However, again, going back to what I, in my ideal world, would like to see is the pricing of the government risk in some reasonable way. It might be more utopia than a reality, but I speak as an economist here.
Thank you very much, Boris. We have time for one last round. We only have about 10 minutes or so. So please, very short and to the point on this one. Let's briefly talk about your views on the supra and international financial architecture. Let's continue with you, Boris. Crisis always raise the issue of changes to the international financial architecture. In Europe, the crisis have resulted in the establishment of the banking union, as you have mentioned, with the single supervisory mechanism and closer cooperation in bank resolution. You have mentioned all of this. Again, given that Croatia has developed from an emerging European economy to an EU member and now to a member of the banking union, to which effect has this affected the efficiency and stability of the Croatian financial system?
I think that here the case is very clear. Joining the Eurozone for a small open economy, emerging market European economy, transition economy, however you want to call it, definitely brings lots of benefits. And some of them are things like usual monetary union cost benefits analysis, optimal currency area one. But the key one actually is the one which is a resilience at the time of the shock. That I see as the biggest advantage. Once you have the shocks like the pandemics, great financial crisis, pandemics, war in Ukraine, being in or out makes a lot of difference. And we've seen it over and over again, and we're going to see it again in the future. This is also what I tell my colleagues in Central and East Europe. When I was in Prague on Monday, I'm going to Warsaw next week, and only let me repeat what I already said. Look at where the interest rates are for the non-Euro EU countries at the moment, and where are the interest rates of the Eurozone countries, including Croatia, which has not yet joined the Eurozone, but we didn't touch the interest rate so far, as markets have already priced in that we got into the Eurozone on the 1st of January 23. And it's clear, during the crisis, or let me say one more thing, spring 2020, March, huge nervousness in the markets. Of course, where do speculators go to? Go to small open economies after their currencies. We see a shorting of the Croatian currency. We see hedging of the equity, even of the banks at that moment of a high uncertainty. And we get a swap arrangement with the ECB, which was a consequence of joining the Eurozone, being on track to join the Eurozone. The moment we get the swap arrangement, all pressure in the markets disappears. The moment it disappears. So it's clear what does it mean for the small open or emerging market countries. It's a clear benefit.
Thank you. Well, okay, now, Leonardo, in contrast to Croatia, neither Colombia nor other Latin American countries have close ties to issuers of hard currency. An alternative, the membership to the Regional Reserve Fund, FLAR, in Latin America, which can quickly provide high currency liquidity to its members in times of financial stress. But is this enough, Leonardo?
Well, clearly not. It is the regional reserve fund, Latin American Reserve Fund, the FLAR, is very small. It is a fund that has about $8 billion in all. It used to be for 8 countries. Now Chile joined us, so we are 9 countries. So it is a very useful fund. It helps us a lot in very specific circumstances, but it is never a substitute for the IMF. we have with the IMF a contingency line, the flexible credit line, which is even higher than all the money that FLAR has. But I would say that for countries like ours in Latin America, which are emerging markets, relatively big, the main purpose must be to have access to the private sector. And in that context, it is key to have the support of entities like the IMF, not so much in the sense that they can lend us, but that they can support us with things like the flexible credit line, which is like a seal of good behavior that allow us to go to the markets and obtain the resources from the market. Of course, in very specific moments, we may need resources from those institutions. In 2020, we disbursed part of the flexible credit line, but it was just a part, and just a part of the line and a part of the finance that we needed in such a very, very challenging context that we had in that year. But in general, the support of multilaterals and of the IMF is more the support to get financing from the private sector and not to finance directly countries like ours.
Thank you, Leonardo. So you mentioned the IMF. So this is a question for both Vitor and Joyce. First, Vitor, over the year, there has been a lot of discussions about whether the IMF can or should fully meet the role of a global lender of last resort. What are your views on these issues, and how can the role of a global lender of last resort be effectively fulfilled? Vitor first.
Thanks, Liliana. I actually liked very much the way that a former first deputy managing director addressed that issue conceptually. He characterized the activities of the IMF as those of a crisis lender and a crisis manager. In order to have the complete picture, one has to allow for the role that Leonardo has just emphasized, which is the role of the IMF as a provider of analysis and information, which is pertinent for the evaluation of our policies. If you allow me one word, Liliana, I would want to refer to the particular situation of low-income developing economies. At this point in time, in accordance with the analysis of the IMF, 60% of low-income countries are in debt distress or at high risk of debt distress. And in 2015, that number was up. It was about 30%. So clearly, we need a cooperative framework where creditors and debtors will get together to manage the situation in an orderly way. And the common framework should deliver on its promise. Last point, very much in line with CGD's work program, the pandemic and the succession of crisis upon crisis puts in danger the goal of Sustainable Development Goals by 2030, which basically means that finance for development is an area which is more of a priority than ever. If we want to meet the challenge of sustainable development, we must act on it now. And I stop here, Liliana.
Joyce, your views on the global lender of last resort?
Well, I very much agree with Victor that the IMF's role, really has been, the technical assistance and the integrity that it provides, and that. But I do want to say a few words on the common framework, because I often hear this put out as an end solution, and I think with the private sector, this is really struggling to gain credibility and momentum. So, the agreement on the general principles for the common framework, I think, has proven much harder to translate into operational outcomes. And so despite its name, the common framework is really designed to operate case by case. the three countries, Chad, Ethiopia, and Zambia, that have so far asked for their debt to be treated, we haven't been able to complete the process. In the interim, they continue to service their debt to private creditors. Their access to financial markets is hampered. They've had ratings downgrades, and there's just uncertainty about the future debt relief. So it has, even though it's put out there as a solution, I think it's been very challenging for participating countries and discouraging for other countries with serious debt problems. And I think there's some recognition, of this, but there's not a lot of solutions to this right now. But I do think that there has to be a list of measures that are taken to make the common framework really serve its purpose. And to move at a faster pace, there has to be some clarification between the incentives for stronger private creditors, including non-bank ones, to join in. Also, whether China is going to join in. Issues like how will comparability of treatment be effectively enforced? Is there going to be a freeze on debt service payments while a process is unfolding? And even the whole ratings issue. I mean, is the market going to be a bigger provider than some of the official creditor money? So you don't necessarily want to take those risks. So I think we all see what the challenge is that these frontier distressed countries are in need of something more. But what the solution is still, a difficult one to fix. So knowing what we need to do is kind of different from getting it all done. And that's kind of, I think, where the risk lies right now.
Thank you. We are run out of time, but I want to give you, all of you, 1 minute for just, your final remark to end this very interesting discussion. Let me just go in the order I see you in the screen. Leonardo first.
Thank you, Liliana. I would take this opportunity to stress what Vitor said before. That is the role of low inflation in promoting access or facilitating access to financing abroad. It is difficult for central banks at times like this to increase interest rates when the government is indebted. But I think it's the best thing that a central government can do for the government. From the point of view of the government, the possibility of reducing the cost of financing relies very importantly on low inflation. And if increasing interest rate in the short run helps to that goal, it is a very important contribution to the government purposes.
I think that has been a conclusion from our conversation that all of you have kind of agreed, right? Price stability, control of inflation as a requirement to have continuous market access and facilitate the issue of debt sustainability that we've been discussing. So I think that's a powerful conclusion. Boris?
Well, as a central banker, I can only agree to that. The inflation now, I think, is a real challenge. It has been underestimated. People say that forecasters were surprised. Some say they were wrong. That's the same thing. But at the moment, it's clear that the inflation rate is getting into the area where it might. I usually say inflation is just a reflection of some disease in the economy, always. And this one is as well. But at some point, it can also start to become a disease of itself. When it starts its own life, when the inflation expectations de-anchor, when the elasticity of the speed of the price changes becomes a function of the inflation rate itself. We've seen that before. We don't know exactly where the threshold is. We know that it's nonlinear, but what empirical research shows us so far is that it usually happens somewhere between 5 and 10%. Mm-hmm. This is where we are at the moment. This is a past historical record. Of course, that can also change, but we have to be aware that we are close, and day by day we're closer to the risk of seeing inflation getting into that territory where it starts to live its own life, and when it becomes much more difficult to control it. This is something which has to make us central bankers very vigilant to act in time and not to allow for the inflation rate to get ahead of ourselves. And when we do that, I always try to remind people it's not only rates, it's also balance sheet. Because don't forget how we got where we are. We got here through the zero lower bound and unconventional monetary policy, where we started to work with the balance sheet, what cannot be done with the interest rates. If I look through the theoretical monetary policy model, menu cost, whichever model you want to look at, if you go that way, one way, you should go the same way the other way if you want to have efficient policy response. And that's not easy. There we again get back into the fiscal issues, the debt, sustainability problems, but I'm afraid that without working with the balance sheet undermines the efficiency of what we do with the rates if we don't use both.
Thank you, Boris. Your remarks bring another important conclusion, and is that there has been so much discussion as to whether inflation was basically created by supply side factors. And early on, there were discussion in many countries, especially in the advanced economies, as to whether, well, monetary policy may not play a role to control for supply side shocks. But the truth of the matter, as you correctly point out, is that, well, what if they affect inflation expectations, and those expectations get de-anchored, and then it becomes a much larger job for the central banks as opposed to acting early and control those inflation expectations. Joyce, your final remark?
Yeah, so the key thing I would just leave everybody with is that I think the financial market volatility is here to stay. And we are not forecasting an imminent recession risk, but I think for many investors, they're asking, what is that risk 6 to 12 months out as we really deplete some of these excess savings, which have been supporting the consumer right now. And I do think that, for the Fed, they're sort of stuck between a rock and a hard place and needing to address the demand-driven price surge, but also, avoid bad hikes that amplify concerns about a growth slowdown. So this is a period that I think is regime change to lower growth and higher inflation. I think there's going to be a lot of divergence between different regions. But one thing I just wanted to say is we have not talked about the flip from quantitative easing to quantitative tightening that also is just beginning. And also the way that market liquidity has continued to drop during this pandemic to sort of levels that are lower than it was before the pandemic, which is exacerbating these price moves. So just a warning that as financial market conditions are seen as a barometer of health, some of the issues that we're facing right now are technical in nature. The market liquidity has been probably about 30% lower than what we saw before the pandemic, and that's made the price action even more exaggerated.
Thank you, Joyce. Well, that brings to the fore also another topic that you all have been discussing, and is that, well, the recommendations have been, well, it's time for structural reforms. It might look very difficult at this point, but perhaps is the time to undertake them, given that the whole world and the financial international system is going to be quite volatile, as you correctly point, Joyce, and it's going to remain like that for a foreseeable future. Victor, you have the last word.
Many thanks, Liliana. It was a truly pleasure to serve under you in this panel with Leonardo, Boris, and Joyce. My suggestion for one-liner that I believe we all can subscribe to is that we need urgently credible price stability and financial stability so that the journey to prosperity may attract more navigators than shipwrecks.
That is a very powerful conclusion, and I think it says it all. So thank you all. I think we really ran out of time. We went beyond our allocated time, but still I want to thank you, all the four of you, and of course our audience for joining us. And this is just the beginning of a conversation, and we will continue with this debate. And for now, thank you to all, and goodbye.
Thank you so much.
Bye-bye.